Hey everyone, this is Ryan Mallory for SharePunter.com. Today is April 1st, 2016. Doing a live broadcast. Just up front, there's no worries. I don't have any pranks that I plan on pulling on you guys here while I do this broadcast, so it is prank free. If I had a good one, I probably would, but I'm not that creative. So just sticking with the bare bones, the facts. What is the market doing today? Why am I talking about 2008 earlier this year in January, and even a faint mention of 1929? So looking at the S&P 500, right? We've gone from 1810 all the way up to 2072. It doesn't take a math genius to figure out that's a 260 point 62 point move. I mean, that is insane. I mean, that's incredible. When this move initially happened, I thought, okay, we'll probably get like 120, 130 points out of this rally before it starts to falter. No, I mean, that was just a little over halfway to what we're currently at right now. So we're closing at new rally highs. 2072, we're in the green for the year. The market's in the green for the year, and it's looking to keep pushing higher. I mean, there's a very good chance that 2100 could be hit next week. Very good chance, and that's really wrecking the minds of a lot of bears out there, and understandably so, because at this point they're like, if I start going long now, the market's going to reverse, and that's the problem with trying to front run a market move, and trying to say, oh, this is when I'm going to be able to time when the market tops out, and it's such a dangerous thing. I almost got sucked into it in the middle of March, and I didn't quite get there. If you look back here when we were going on this little 4-day romp back on the 16th through the 21st, I started adding a little bit of short exposure, like talking like one position, like 10% of my capital, to the short side, starting to think, okay, we're getting a little bit overheated here. I think we're going to get maybe a mild pullback. And ultimately, I was actually right. I wasn't looking for a big 10% drop over the coming weeks or anything like that. I was looking more or less for a light volume pullback that allowed the market to work off its overbought level some, so that it could resume the uptrend. And we eventually did that. I was trading SPXU, and we're talking like SPXU is like a 3x ETF on the S&P 500. And so basically, if the S&P goes down 1%, you're making 3%. So that's what I was trading here, and you can see I was barely able to make $2 or 2.3% on the trade. So it wasn't what you would call like one of my greatest trades, but it was pretty much all you could get on the pullback here. And but what's happened though is a lot of people, instead of respecting the fact that, okay, this thing is breaking through resistance levels, and it's been breaking through every resistance level, starting with this 50-day moving average. It breaks through that, and then it gets to where it confirms the double bottom pattern, and then it just keeps on romping higher here. It pulls back a little bit, turns into a bull flag. You got a little bit of some crazy action right there, and then it just keeps moving higher and higher. And so the Fed has gotten ultra dovish on this market, and that's at this point has caused what happened in January and for half of February to basically fall into the backdrops. And so a lot of traders, they're still expecting the drop to resume, and that may not happen anytime soon. I don't know. Maybe it happens next week, but what I'm trying to say is that there's no evidence that it's happening next week. Yes, we are extremely overbought, and it's still continuing to go higher. We may hit new all-time highs. I mean, that is literally a possibility that the market hits new all-time highs in the month of April. And there's nothing that the bears can do about it. There's nothing that anybody can do about it. It's just what the market wants to do. So so what happens here is that people think about what happened in January and February, and they want that to happen again. They can't let that go. And there's this market. Nothing's changed with this market. The same issues are still out there. Oil's already been pulling back for 8 days. Yes, oil has been down for 8 days. But the market doesn't care about that right now, because if it did, over the last 8 days, we would be lower like oil. So there's been a decoupling there. Now we could resume trading with oil in the coming days. I don't know. But right now there is a decoupling. The market doesn't care about oil. It just doesn't. And so the market's going higher. Yes, things have changed since January and February from the simple standpoint that the market's higher. The market, it's trading higher. The bulls are buying every stinking dip that is out there. And so if you keep trying to short the market at every turn, thinking that, okay, it's got to turn now, you're going to be left in the dust with losses. So the hardest part for a bear at this juncture is to say, okay, fine, I'm going to start buying stocks. And then the fear is that once you start buying stocks, that's when the market's going to top out. And then you had wasted all of these trades that you had taken all these losses on trying to nail the top, only to start buying the stocks when the market actually does top. And yes, that's a possibility. That can happen too. It happens to everybody at some point in their trading career. But don't let that fear, that's a fear, that's an emotion that you're letting get in the way from just trading what the chart's telling you. And right now the market doesn't care about the bears wishes about going back down. So the other thing that happens is that earlier in the year we're talking and I'm telling you, this market took a huge sell-off, in late December and then again in February, and we even confirmed we didn't confirm it on a closing price pattern, but at intraday we actually broke below the neckline of this massive head and shoulders pattern that you can see really clearly if I pull it up on the weekly chart. You got the left shoulder right here, you got the big head right here, and then you got the right shoulder. And actually what's at stake here is the market's at risk of nullifying this entire pattern that's been in play for the better part of 2 years. I mean, that would be amazing if we break above this right shoulder and completely trounce this head and shoulders pattern. So so we see this big pattern, and then also we see the huge sell-off in the early part of this year in January and February, and we automatically go back to 2008. And I don't know why it is as traders that we take like the extreme conditions of like what we saw in 2008 and automatically apply it to the first hint of a sell-off. And maybe we have a sell-off that's similar to 2008, or maybe it's even worse. But no market condition is the same. There's no 2 years that are the exact same. I mean, there's some kind of parallel. There's can be parallels at times between two different years in the stock market, but every year in the market is unique into itself. And to try to trade based on what you remember happening in 2008 and applying that same, those same extreme kinds of conditions to 2016 isn't the best thing, because what you start doing is you start shooting for the fences. You start thinking that you're going to hit some major home runs, because you remember back in 2008, you probably said to yourself, I will never let a shorting opportunity like that ever go to waste again, or, I'll never let the market beat me up again, or I had so much success in 2008 that I'm just going to repeat it again here in 2016 as this market keeps selling off. It's going to go down 30%, 40%. And that really starts wreaking havoc on your trading strategy. You have to take the market for where it's at right now, not for where you think it's going to be a week from now or in December, or where it's been in 2008 or earlier this year, or, for that matter, where it was at in 1929. I mean, goodness gracious. I mean, if you think back in 2008, people were already comparing it to 1929, thinking that this was going to be the next great depression. And then all of a sudden in March 2009 we rally and we just take off. I mean, and the market hasn't ever looked back since. So you got to be really careful about trying to enforce those beliefs, those hardcore beliefs that you have about the economy and where you think this market should be going, and then trying to infect your trading with those beliefs. So don't do it, man. In any case, it's been a good week of trading overall. We added one new trade to the portfolio in the Share Punter Splashdown. And when I say we, I'm not talking about it like I have like a team of traders that, I'm the only trader. And when I talk about we, I'm talking about the community of traders in the Splashdown that subscribe to the Splashdown each month and are part of that chat room. So I issued an alert today to the chat room for AMTD. It turned out to be a really, really good trade overall. closed above 32.25. I got in at 31.61, so I got in a little bit before it broke out, but it had support at the 20-day moving average. You can see here it had bounced like on 3 separate occasions. It pushed through this breakout pattern. This is the best chart in my portfolio right now. I really like this chart a lot, and I think there's a very good chance that this thing could see 35 in the coming week or two. If you look at Netflix, this stock has been a roller coaster for me this week. I got in on Netflix back on Monday. I got long on it. And, you know, I got long on it at $124. And it did good for me. It rallied for 2 days, and then we got this candle here, and that kind of shook me out of the position some. I didn't want a stock that, you know, I had at one point like 4% in gains, and it had pulled back to about 2% in gains. The last thing I wanted is to see those 2% in gains turn into a negative trade, because then I'd have let a 4% trade go into a negative territory. So at some point, you got to pull the trigger and say, you know what, it may still keep going back up, but I need to go ahead and take home my gains. And but the following day, it did try to sell off initially. This was yesterday, and held that 10-day moving average. That was pretty inspiring for me because it's done that a few times in the past. And I got back in, I think like literally 15 cents higher than where I sold out of it at. So I got out at 102.35. I got back in at 102.50. So there's really nothing lost by getting out of it. And now it's trading at 105.70. So really a nice trade, and actually is worth more than what I sold it for originally right now. So that's up about 3.1%. And then I sold MJN towards the close today. You can see it's a beautiful chart. It came out of this bull flag pattern really nicely earlier this week. And it gave us four out of 5 days of just solid buying. And it may keep going higher, but at this point, the market being as overextended as it is, I'm going to be a little bit quicker to take the gains. I booked about 4.6% on this particular trade here, and that's great. You know, consistently making profits and moving on to the next trade, taking that capital, applying it to another winning trade. That's what winning's about. That's how you do it in the stock market, and that's what we did today with MJN. So I got in on this one at 82.05 and sold it today I got 82.05 on Monday, sold it at 85.81 today. So yeah, like I said, a nice 4.6% trade, and that's definitely not going to hurt the portfolio at all. And then we got good old Amazon here. And I kept this one over the weekend as well. Nice little bull flag here, working over the last 3 days. Nothing new, too concerning. We had a little bit of weakness yesterday that formed a bearish engulfing pattern, but I didn't think it compromised the overall trend and direction of the chart. You have a nice little 5-day moving average offering support underneath, and it's been a constant there for the stock over the past couple of weeks. And so I decided to hold this one yesterday and hold it again today. So we've had Amazon now for about 4 trading days. We'll hold it into Monday, and it could be a nice trade that we hold for over a week here. But this one definitely has the potential, especially after what we saw in Facebook, where it moved, you know, like day after day higher up until like 116. This stock has the potential to get up to 650 if this market momentum can keep going here. So 650 is definitely a possibility in the next week or two if we can stay in the trade that long. A few others to look at, a couple of trade ideas. CAA, nice inverse head and shoulders pattern. Here you get the left shoulder, then you got the head, and then you got this, you know, mumbo jumbo of choppy right shoulder price action. But nonetheless, it's just a shade under confirming. You can get in around 33.50. If it breaks that level, you got a confirmed pattern there, and then it wouldn't be surprising to see this thing trading up north of $37 here in the near term. Let's look at Facebook. I don't think it's worth trading at this point. I thought about it earlier today at the market open. I ended up getting into Ameritrade instead, which provided even a better return, up 2% on Ameritrade, like I said earlier. Facebook though. I mean, it's a solid chart. I mean, you look at this. I mean, I don't know how many days this is, but pretty much since the beginning of March, it's only had like 4 down days. That's astounding. So it's on a huge roll. The dip buyers jumped in off of that 10-day moving average. I wouldn't get into it at this point. Anytime it comes back to the 10-day moving average, as long as it doesn't look like the market's in a complete free fall, I think it's worth buying. So use that 10-day moving average to buy Facebook. ADS, cup and handle pattern here, though quite the pointy cup basing pattern here, but nonetheless still a cup and handle pattern, and it's breaking out too. It got over 220. I think you can trade this with a stop loss below 214.23 by doing that. Actually, let's change that, 213.86. Pretty nice risk reward as a result. If it gets into that gap, you don't want to be holding on to that stock. If it does that, there's no reason to hold it beyond that. So that's your risk parameters. Your upside is it fills this gap up into 240s. So I think that's very possible. It's a very good looking chart and a stock that I'll be interested in going into next week. JPM, I haven't been overly crazy about these banking stocks. That's why I chose a brokerage over the big banks, just because they've been not the biggest fans of Janet Yellen not wanting to raise rates. So it's caused a little bit of a sideways action. But if you look at like XLF, I mean, XLF, which encompasses everything financial, shows that it's wanting to break out. So that made me want to find something that was financially related there. And in doing so, I landed AMTD. But if you look at JPM, kind of like I think that it's like basically got a bullish engulfing candle pattern of the last 5 trading sessions. So I mean that's very good there, but you can see here it's broken this rising trend line that was really nice on the stock and hasn't been able to get back above it yet. That's really the major holdback. Ignore all these other lines that are on the chart, but for me that's the big holdback there. You could even probably make a case that you had like a bearish wedge pattern. Let's just get rid of these candles or these lines here. They're distracting me. But you can make a case that this is a confirmed bearish wedge pattern that's broken, and so that the likelihood is that this thing trades lower in the coming weeks. GILD, really impressive move today. I thought about it. I'm not a huge fan of biotech stocks, so really I kind of like to avoid these things at all costs. But early on, I was looking at this thing at around 92, 90. I think that was probably right below $93 is where I was looking at it at. And I mean, it's made a good move. It looks like it's kind of poised for, or it's in the process of a secondary breakout. I would say the initial breakout was around 92 and change, and then now around $94. It's doing like a little secondary breakout of some minor resistance. But I mean this too, I mean this biotechs have been weighed down a lot over the recent weeks, but they could definitely make a move up to 100 again. And then you got Goldman Sachs. We actually have this one in the SharePlanner investment system, been really stout so far. It's breaking out. So between Goldman Sachs and JPM, I like Goldman Sachs much better. It's clearing a lot of this mess here. You could even say that this is like a inverse head and shoulders pattern, left shoulder, head, and then right shoulder here. That it's breaking out of sort of like CAA, similar chart pattern to that we just looked at earlier. So let's look at Apple. Also in the SharePlanner investment system, doing really good. I think this one has a potential to go to like 110 to 1. Well, it's already at 110, but I think it can go north of 110 and maybe even hit 115 in the coming weeks. Overall, really good. You just got to watch out for this falling trend line here off of the July highs. If it could clear that, my goodness, it could be ready to make a move towards all-time highs again. And then you got Tesla, which if you look at the Model 3, really cool, man. I mean, really cool. And I'm not going to buy one or anything like that, but nonetheless, really awesome. I talked to a friend today who was griping that he had sold his shares at Tesla in Tesla at $150, and today it went as high as $250. So, kind of missed out on a 66% gain if he could have held on to it that long. But nonetheless, though, I mean, it's broken. I was surprised when it broke through 223. I thought for sure it would hit some resistance here on this falling trend line. It didn't. It pushed right through it. But maybe the Model 3 is like peak rally here. Had really good reviews. Everybody seems to like it, but despite finishing 3.4%, it gave up a lot of the day's gains. So that would be something to watch there. I don't think it's worth getting into at this point. I mean, for Pete's sake, this thing has rallied like 66, 70%, and it's a big company. It's rallied a lot, and it's not had really any major pullbacks. So if there's anything that's ever been primed for a pullback, you get in these big, I call them Yao Ming bars. If you remember the big, tall Chinese basketball player that played in the NBA, he was head and shoulders above everybody. So I call it Yao Ming. Volume bar, when it, and oftentimes, that coupled with this kind of price action marks reversals and stocks. So that's going to do it for today. We focused a lot on individual trade setups. We looked at some different theories with the S&P 500 and how you should be trading it. And if you have any questions, feel free to hit me up at ryan@shareplanner.com, or join the SharePlanner Splash Zone. I'm telling you guys, it is a great community of traders. There's lots of ideas floating around. There was one earlier today, or actually it was 2 days ago, but they were reaping the profits in FTNT. It's had a really nice run this week. Just lots of trades like that are circulating in the chat room every day. I also post all my trades. I provide the stop losses, the targets, the rationale, the chart, how it looks when I'm getting into it, and everything else. I also provide that via text, and I provide it via email. So if you'd like to join, feel free to. You can go to shareplanner.com/splash zone, and you can find out all about it there, or just go to shareplanner.com and click on Splash Zone on the menu bar. That's going to be it for today. The markets are closed. It was a great week of trading. I had fun with everybody, and have a good weekend. Get refreshed, get rejuvenated, and be ready for some more trading on Monday. Thank you, and God bless.